Welcome back to the Energy Signal Podcast, episode number 7, your weekly roundup for the latest trends, policies, and market movers shaping the U.S. and global energy landscape. I'm your host, Josh Lefebvre, coming to you from the energy capital of the world, Houston, Texas. We're recording this episode today on Sunday, September 14th, 2025. In today's episode, we'll be discussing why oil ticked up while natural gas slid and what conflicting IEA versus OPEC forecasts mean for these producers. We'll look into Phillips' 66 $1.4 billion refinery deal with Cenovus, as well as Diversified Energy's $505 million acquisition of Canvas Energy to expand its footprint in Oklahoma. We'll check out why Trump is suddenly pressing NATO nations to halt Russian oil purchases before actually imposing further sanctions. We'll check out Exxon's new synthetic graphite breakthrough that could extend EV battery life by up to 30%. And then finally, we'll look into the EPA's controversial proposal to end mandatory greenhouse gas reporting for up to 8,000 U.S. facilities. Make sure to stick around. You're not going to want to miss this one. This episode of the Energy Signal Podcast is brought to you by StageTracker AI, the real-time frac intelligence platform that's powered by AI agents that help engineers and operators stay ahead in the frac game. Whether you're trying to optimize pump schedules, reduce NPT, or benchmark crew performance, StageTracker gives you the live view of what's really happening, stage by stage. No more waiting on the post-job reports to know if you're behind. Learn more at stagetracker.ai because every minute counts on the job. On now to commodities. So West Texas intermediaries, they actually increased from $61.97 to $62.59, a slight 1% increase over last week. And this was actually quite surprising to me because we're seeing conflicting reports between the International Energy Agency on one hand, based out of Paris, and then OPEC on the other hand. And basically the IEA's view is that too much oil supply is coming online, basically from OPEC countries, from US, from Brazil, and the demand isn't growing fast enough. And this, of course, means a surplus. This means lower prices, and this means stress for producers. Now, on the other hand, OPEC, they're stating that the demand will be stronger and supply wouldn't be able to keep up. And the market could even go into an actual deficit in 2026 if OPEC keeps pumping at today's levels, right? So they're using this to justify their increase. But again, take that with a grain of salt because there are obviously a lot of political leverages that are being used here behind the scenes. So we'll see how this plays out. Now, gas, on the other hand, gas fell from $3.09 down to $2.96. This was a 4.2% decrease. And this seems to have less to do with political reasons and more just driven by cooler temperatures that were recorded across the eastern and midwestern regions at the start of September. All right, on now to the big US energy capped stock players. So first up is ExxonMobil, ticker symbol XOM. They grew 2.2% from 109.73 cents up to 112.16 cents. Chevron, they also grew 2.1% from 153.91 cents to 157.11 cents. Phillips, they actually fell slightly by about 0.7%. They went from $99.10 to $92.95. And this, of course, comes after the massive layoffs the company announced over 2 weeks ago now. So no surprise there. I mean, I think overall, despite the uncertainty around energy, the big dogs, they're faring quite well in these uncertain times, right? And it's the smaller cap stocks, the smaller caps companies that suffer the most when these economic downturns happen. Their margins are much smaller. They don't always have enough capital to weather the storms versus a Chevron, versus an Exxon that just have so much excess cash at hand. So, I mean, as the price of oil continues to drop, I'm sure we're just going to continue to see more acquisitions. All right, on now to our deals and drills for the week. So our biggest story is that Phillips 66 announced that it will acquire the remaining 50% of WRB Refining from Cenovus for $1.4 billion. So this would gain them full ownership to the Wood River, which is based out of Illinois, and Borger, based out of Texas, refineries. The deal would add about 250,000 barrels per day to Phillips 66 already massive refining capacity, and it would greatly expand its portfolio of its ability to process a wide range of crudes. Phillips 66 shares rose 2.7% on this announcement. Meanwhile, Cenovus rose also to about 3.3%. Cenovus stated that they will use proceeds to cut debt and increase buybacks. In other news and other acquisitions, Diversified Energy will acquire Canvas Energy for $550 million. This would give them an additional 23 producing wells in the Oklahoma region. These assets are expected to contribute somewhere around $155 million in the next 12 months. So Diversified, of course, is backed by the Carlyle Group, and basically they're just aiming to dominate in that Oklahoma region. According to a spokesperson, they stated that this acquisition is expected to extend its track record of buying cash-generating assets that deliver long-term shareholder value. On now to energy geopolitics. Our biggest story around the world is that Trump has threatened new U.S. sanctions on Russia yet again. But this time he's stating that he will only act if all NATO nations stop buying Russian oil and adopt a similar measure. Now, myself, all of us, I'm sure we've seen Trump repeatedly threaten these harsher penalties, but he lets deadlines pass. I guess it fuels the perception that maybe he's just a little too close to Moscow. Now, these aggressive sanctions could curb and push up global oil and gas prices even higher. NATO buyers, of course, still include Turkey, Hungary, and Slovakia. So we'll have to see how this one plays out over the next couple of weeks. On now to renewables and innovation. So on Friday at the University of Texas at Austin, they held what's called the Annual Energy Symposium. And I actually had the pleasure of attending this in person, where CEO Darren Woods of ExxonMobil unveiled a new synthetic graphite that could extend EV battery life by up to 30%. In that talk, he was talking about this will enable faster charging and longer range. And according to him, it's already being tested by multiple EV makers. Now, in addition to those advantages, this graphite could also reduce dependency on mined graphite that's coming from China. So this would also offer US political and financial advantages under the current trade policies. So if trials go well, Exxon could scale production with commercial rollout targeting 2029. And while Exxon has, of course, faced criticism over climate issues in the past, Darren spoke a lot about how he sees the company, these EV batteries, as a strong long-term investment and a natural fit for its expertise in carbon and hydrogen molecules, right? Of course, this synthetic graphite is still being built using carbon. And I thought this was very interesting, right? When he was grilled about, why is Exxon not going after wind or renewables? Darren Woods, he was stating that, Exxon is a molecule company, right? It has the ability to extract molecules from the earth and then refine those to turn them into energy. So this whole wind, solar, it just doesn't play into their core competencies. But that's not to say that they still don't care about, environmental impacts. At the end of the day, it's all about reducing emissions. And, these EVs have obviously shown a lot of progress in that area. So it's only natural that if EVs are going to be the way of the future, Exxon is simply going to have to follow suit. And while not going completely into renewables, these new carbon molecules that they could then use to create the synthetic graphite, it fits. So our other big story for renewables is that the EPA proposed ending the mandatory green gas reporting program, which requires 8,000 facilities and suppliers to disclose emissions. The agency was quoted as calling it burdensome and unnecessary. The move follows Trump's executive order to roll back climate rules and expand fossil fuel production that we've been talking about on this show for weeks. So, and of course, this also leads to the US plan to withdraw from the Paris Agreement. If finalized, reporting obligations would be lifted for power plants, refineries, chemical plants, fuel industrial gas suppliers, and CO2 injection sites, though large oil and gas operators must still report methane. So the industry reaction is kind of split, right? So on one hand, this does play into Trump's big, beautiful bill of bringing back that energy dominance. But on the other hand, if we're not keeping up with our emissions and how much we're producing, who's to know what kind of long-term environmental impact this could have. So as I mentioned earlier, I had the privilege of attending the Energy Symposium at the University of Texas, Austin on Friday. And one of the overlying themes of that symposium was, of course, the AI race and how this is fueled by this massive energy demand and how the US has just not been able to keep up with this demand for energy. Now, they spoke a lot about, energy as a matter of national security, right? Those who control the energy, essentially, they're the ones that hold the power. Now, a lot of the topics revolved around China and China's ability to produce energy, China's ability to build this amazing electrical grid, China's ability to produce these electric vehicles. So on one hand, the US, they control the technology. They have all of the best chips that are coming into the US. But on the other hand, China just has a much better ability to harness this energy, right? So basically, the US, if they want to stay ahead in this, AI race, they're going to have to leverage all forms of energy, right? Not just fossil fuels. Like, yes, fossil fuels are extremely important to the American economy, but we need to start, also leveraging these renewables, this wind, this solar, these batteries. And there's no reason why they can't all play along with one another, right? A lot of people have been criticizing Trump for removing these incentives, for removing these tax breaks. But I mean, this was bound to happen, right? An industry eventually needs to be self-sustaining. They can't rely on the government. So I think the government has certainly helped that industry get off into the right direction, but now it's up to us to harness that energy in a way that will be long-term, that will be sustainable, so that we can eventually win this AI race and maintain that global power. So again, thank you so much for tuning in. This is Josh from the Energy Signal podcast, signing out.